Hey, how you doing? And welcome to Livewire's Buy, Hold, Sell. I'm Selby, and today we're taking a look at 5 stocks with sustainable and fully franked dividends. To do that, we're joined by Peter Gardner from Plato and Andrew Fraser from Merlon. Okay, just to start the episode out today, I want to know why franking is actually important. Pete, I might start with you.
So franking for us is no more important than anything else, but it is 100% valued by our investors. So we manage our income fund specifically for zero tax investors, and so we value franking just as high as we value cash dividends.
Okay, and are you looking for stocks that have 100% fully franked dividends? Could it be 60% fully franked dividends? Like, what are you looking for when it comes to fully franked yields?
Like Pete said, franking is extremely valuable for our investors, and we actually include franking credits in the value of our company. So when we're valuing companies, we actually add the value of franking credits to those valuations, which does give us a skew towards companies that have high franked dividend yields. Whether it's 100, 80, 90, we're agnostic about that. It's more around, do the share prices reflect an opportunity to preserve capital and grow capital over time.
Okay, let's take a look at a few stocks with that 100% fully franked dividend yield number. First up, we have oil and gas giant Woodside Energy. It has a dividend yield of around 7.73%. Pete, I'm going to start with you today. Is it a buy, hold or sell?
Yeah, Woodside is a hold for us. It's interesting you mentioned the 100% fully franked in nature, because Woodside have actually flagged in their kind of last result that they're likely not to be able to continue to fully frank their dividends, as more of their assets after the BHP assets they took on are offshore, and therefore they'll be paying less Australian tax. And so, they won't be able to fully frank their dividends going forward. The challenge in Woodside is their Sangomar asset, which is in Senegal. And Senegal just recently had a change of government, and there's talk of extra taxation on that. And so that's kind of causing us to be a bit wary on Woodside, but it's certainly looking very cheap.
Okay, its share price has fallen around 20% over the last 12 months. Andrew, over to you. Is it a buy, hold or sell?
It's a buy for us. We've just recently added that to the portfolio. We do recognise there are some concerns around that particular asset. But post the BHP petroleum asset acquisition, the portfolio of producing assets that the company has is highly cash generative. At a macro level, there's been continued underinvestment in future oil production, which should be supportive over the medium term of the oil price. But regardless of that, their cost of production, including capex, is for majority of their assets is around $20 a barrel, compared to US onshore producers, which are around $60 a barrel. So even if prices fall, they'll wear less pain than some of their major competitors.
Okay, if you like chicken, this next stock's for you. It's Inghams Group. Staying with you, Andrew, is it a buy, hold or sell?
I'm not going to bite on that one. It's definitely a sell for us at the moment because we don't own it. Having said that, it has underperformed a lot, so we are doing some more work on it. I think over the short term there are some concerns about revenue growth slowing and also costs being harder to manage. The other concern for us is that it still appears to be a consensus long, with the majority of analysts that cover the stock have a buy recommendation.
Okay, its share price has lifted around 28% over the past year and has a dividend yield of around 6.18%. Pete, is that finger licking good, and is it a buy, hold or sell?
It is. We definitely like to have a bite of Inghams. We think more consumers are going into the chicken market with the kind of higher cost of living. Chicken's obviously cheaper than beef or lamb at the moment, and so that's kind of giving tailwinds to Inghams. The other thing that's providing an opportunity for Inghams is there was the bird flu scare down in Victoria. But that was nowhere near any of Inghams' facilities. And Australia's been able to manage these pretty well in the past. There's actually been 8 bird flu scares in the last 50 years in Australia, and we've been able to control each of them. We think this, because the share price dropped after the scare, we think this gives investors a good opportunity to get in.
Okay, next up we have Nine Entertainment. There's quite a lot of scandal there at the moment in its newsroom. Pete, do you think investors can look through that drama, and is it a buy, hold or sell?
It's a sell for us. We still think the challenges in that industry are very difficult. They're competing with the likes of your Facebooks and Google for advertising revenue. It's a tough environment to be in, even though the current management, we think, have done a pretty good job, despite the scandals with regards to Stan or Nine Now. And then the other thing that these scandals bring is that generally management focus lowers and management stability kind of comes into question. And so it's a sell for us at the moment.
Its share price has fallen around 27% over the past 12 months, but it does have a dividend yield of 6.25%. Andrew, do you think that's attractive, and is it a buy, hold or sell?
For us, it's a sell as well. Notwithstanding that underperformance, I agree with Pete. The outlook is challenging both in a more cyclical sense in the short term, but longer term structural issues around free-to-air TV and publishing. The other area of concern for us is, with Domain, it is the clear number 2 player in a great industry structure, but somehow realestate.com continues to grow its market share. Means you can't rule out a winner-takes-all scenario, and given they own 60% of Domain, that's an area of concern for us.
Okay, we asked our guests to bring along a fully franked stock that they're buying today. What have you brought for us, Andrew?
It may not be the most high-profile stock, but for us it's the Australian Stock Exchange, ASX. It's started to look interesting to us. We've been adding it to the portfolio over the last couple of months. At the moment, they're suffering from a cyclically depressed trading activity and IPO volumes. We do expect over the medium term that to recover to more normal levels. The other big issue with the ASX is the well-publicised cost blowout and then eventual canning of the CHESS settlement replacement system. That's also been coupled with a period of excessive cost growth. New management are very much focused on reining in those costs over the next few years, which should be supportive of top line growth and costs coming down, should be supportive of earnings and ultimately dividends growing through the next few years.
Okay, over to you, Pete. Your time in the hot seat. Which fully franked dividend darling are you backing today?
We're backing Origin Energy, which works well for your hot seat because they produce energy. We think Origin Energy have increased their dividends quite significantly in the last 12 months, and we think they can continue to do that. Their investment in their AP LNG asset has reduced, which allows them to pay out more going forward. And there's also growth areas of that business as well in the form of Octopus Energy, which is a UK kind of company that they've got a big stake in. And that's growing quite strongly. So we think Australian Super has actually done us all a favour by rejecting the Origin Energy takeover. It's currently trading above the takeover price, and we think it's going to continue to go up going forward.
Well, I hope you enjoyed that episode of Buy, Hold, Sell as much as I did. If you did, why not give it a like? Remember to subscribe to our YouTube channel. We're adding so much great content just like this every single week.